I had my own hedge fund at a point that outperformed the market by 300%. I wanted to strike for the fences and try and hit a home run as they did. I've had a personal one-on-one conversation with Warren Buffett. He is amazing. He's this great investor. And maybe he's also one of the monkeys that got lucky.
Hello, everyone. My name is Connor Kroll, and I'm the founder of West Bank Financials. And today we're joined by a really exciting guest, Mr. Brian Vowinkel. Mr. Vowinkel is an experienced leader in the finance industry with various roles at major wealth management firms and the United States Army as well. So a pretty diverse career path. Now, to start things up, Mr. Vowinkel, could you please tell us a bit more about your career path and your overall journey into the realm of finance?
Sure. So I served as an Army officer. I really enjoyed my time. I was an airborne ranger. And in that world, you have to make decisions with a lot of risk and you don't have a lot of certainty. So you have to have contingency plans and you have to try to address the risk, and lives are on the line. I finished my time in the Army and went to get an MBA at Harvard Business School, got recruited by Goldman Sachs to Wall Street, and I felt that there's a lot of similarity in the military where you have to assume risk and there's a lot of uncertainty. There is not 100% guaranteed certainty in anything that you do in the world of finance. And so it was a very interesting transition, and I still use some of those skills in the Army in finance.
So you mentioned that after the Army, you transitioned to Harvard Business School. What really motivated you to go into finance, really, and specifically Harvard Business School?
So I had worked 2 jobs in high school saving money for college, and then West Point turns out to be a full scholarship. And so I was able to invest that money, and this is 1986, a while ago. And then in 1987, the market crashed, and this money I'd worked so hard for evaporated in a large sense. And I really thought, wow, I have to pay more attention to finance. And so I studied the markets in my free time. Not that you have a lot at West Point or in the Army, but I really liked investing, and I thought, okay, now I'm smarter. I've made myself smarter, read a lot of books and interviewed people as well in the world of finance, and learned to mitigate the risk that I had assumed earlier so that my money would not evaporate.
I see. And you mentioned you got involved in a little bit of investing. Was that in high school at all?
So, no, really, my father had helped me get some mutual funds going when I got into West Point, because I was able to invest that money instead of using it for college. And so really my dad had just helped me with some mutual funds.
I see. And regarding West Point, I believe, what did you major in at West Point? Sorry.
So everybody when I went had to be an engineer. Mm-hmm. They've changed it since, but you had to be an engineering Bachelor of Science major. You could specialize in aerospace or in mechanical or civil or electrical. But I was a general engineer and I double majored in history.
I see. Did you find that those majors translated to finance at all at Harvard?
Problem solving on the engineering side for sure. And then history, understanding cycles and patterns and mistakes, that they definitely help it.
I see. And regarding your time at Harvard, did you find that the skills you learned there, whether it was like wealth management or investment planning, did that translate to like real life in your job, in your career path as well? Like maybe at Goldman Sachs as an associate?
So good question. So there are a couple different paths you can take at Harvard Business School. Some do marketing. I took the investment management path. And so it hadn't really transitioned into wealth management back then. It was really about seeking a return and assuming risk to get that return, and evaluating those risks and analyzing the paths that you might get. Multiple path outcome is often referred to as Monte Carlo analysis. And that really was very interesting, emerging math and problem solving for people to help them make decisions in uncertain environments.
I see. And did you learn these skills at Harvard or maybe from like other internships or like a mentor outside of general classes?
So it was generally from Harvard Business School. And then I did do an internship at Goldman Sachs while in between the years. And then I double interned and did a Booz Allen Hamilton management consulting for a Fortune 200 company. That was very interesting.
And at Goldman, because I know for like a lot of viewers watching this, it's especially if you're trying to get into finance, it's kind of like a token company. Like that's one of the main goals. What were your main responsibilities there, and what did you do with your job as an associate at Goldman?
Sure, it's an iconic company. They have a very prestigious brand, and it is hard to get an internship and get full employment there, and very competitive. They teach a very rigorous program, and they put you through 6 months of this program to include your certifications and licenses for security trading and investment advisory work. So Series 3, Series 7, Series 65 or 6. And it was a detailed program, and you worked with people from around the country. So Goldman would bring in their bond traders and their equity traders. They would bring in their investment advisors from around the country. San Francisco would fly in, Texas, Florida, Boston. They'd all come in and teach, and you would go to dinners with them and ask informal questions. But it was a very rigorous program for 6 months.
And are you still in contact with those people today, those mentors?
Some of them, definitely. And really colleagues I'm bonded with the most, because you're in the crucible and you're all trying to perform, and you're all alpha performers, and it's a tough environment in that respect. But still, I made friendships that last to this day.
And you mentioned that like alpha mindset that's often seen in finance. Did you find it manageable to have like a work-life balance, especially in your early stages, like at Goldman and at Harvard?
So that's an interesting question. Goldman absolutely has high pressure to work and perform. And coming from the military, I was used to high pressure to work and perform. And finance is very important, but lives aren't on the line. So as important as I was assigning my tasks and priorities, it wasn't life or death. So I had a pretty good life balance. Now, some people had not had that experience, and they felt very stressed, and they complained about the hours. But to me, I had a hot shower, and I had 3 hot meals, and I was sleeping under a roof in an air-conditioned room. It was much different stress, and I wasn't bothered as much. Work life, you get out of life what you put into it. So it is what it is.
Well, that's good to hear, especially because of the stigma and general stereotypes about the high finance, lack of a work-life balance. And another question about Goldman: after your internship, did you stay there, or did you get a job after college? And if not, why did you go to a different firm?
So while I was in New York, I was born and raised on the West Coast, California. I'd been stationed in the Army at Joint Base Lewis McChord, and I really missed hunting and skiing, and those activities are really hard to do in New York City. So I would take one trip a year, and I was paying very high taxes in New York City, and I just loved the West Coast lifestyle. And Goldman Sachs did not have an office in Seattle, and I said, hey, to the higher ups there, we need an office in Seattle. You have major companies. Microsoft is there, Amazon is there, Starbucks is there, Costco is there, Boeing is there, Nordstrom is there, Alaska Airlines. We need to have an office there. And they finally relented and said, okay, you've convinced us, help round up some other people, and we'll support you with some staff, and we'll open an office out there. And there were 6 of us professionals and about 8 support staff that came out and opened that office. And it was a very interesting time. We were downtown Seattle, and I got recruited away by another firm that had a very different model for investment advice, and it really appealed to me. And I parted ways, and eventually all the 6 people that helped open that office left Seattle, and I'm the only person still here in the area. Other people took off for various parts of the country and even out of the country. So they didn't have as much loyalty or love, even though some of them were from here. And that was just a very interesting change of direction for people to help open that office.
Yeah, as a born and raised Washingtonian myself, I can respect the loyalty to the West Coast.
Yeah.
But you also mentioned you transitioned firms after, or you got recruited after you found a new firm with a different investment model.
Yeah.
Would you be willing to go into how it was different
Sure,
from Goldman?
Sure. And what really appeals to me, when you're giving advice from a factory that manufactures product, there's a huge incentive to push their product. And that's a conflict of interest if you're giving the best advice for the person sitting across the table, your client. And this other firm was totally objective, had no products. So they just looked at the universe and they said, hey, this would be best for you. And it didn't necessarily have to be Goldman Sachs. Now, Goldman Sachs had great products, but they also had some mediocre products, and they even had some subpar performer products. And they had incentive programs to push things to clients. And that's uncomfortable when you're trying to tell the clients the very best thing for you. Now, they did have some special access investments that was kind of the Rolls-Royce model of delivering something, or Ferrari, where, hey, you can only get this if you talk to me at Goldman Sachs. This other firm said, oh, we have 3 clients in those products. And that was so eye-opening to me. Wait a minute, I thought this was exclusive, you had to deal with Goldman. And what I learned in my level of sophistication growth is money will flow to the best things, and people will accept money for rewarding them for building good things. And so the exclusivity was really a misnomer. It didn't really exist.
I see. So safe to say there were some moral issues with
Sachs. Oh yeah. And they definitely have been penalized for some unethical behavior. And there are people in that alpha wolf mode who just don't have a moral grounding that you should have. And it's across a lot of firms. It's not just Goldman Sachs.
And speaking of in the past, how these firms could have had some things that were morally wrong, especially with implementation of ESG as of now, how have you seen these firms, like wealth management firms, such as the ones you brought, that change over the past 10, 15 years?
So that is very interesting. There's so much change. We could write a book about it. It's going to be hard to actually stay on one topic, but there is a big move to index investing, to passive investing, where you shouldn't have to pay for beta, which is gross market moves, and you probably are only going to get a chance for alpha, which is excess return from the market, if you do private investments, private credit or debt, private equity. The move has been gigantic, and there's trillions of dollars now that are passive, and it's a tidal wave shift for investment advice. And big firms, even Goldman Sachs now, are doing some passive things. And there are always waves of interesting things. Artificial intelligence is huge right now. Virtual reality was huge in the past. Biotechnology was huge. There's all kinds of hype cycles, cryptocurrencies, and the blockchain. There's just waves and waves of excitement, and some of it is marketing hype and promotion. Like we have Copper River salmon here that is very similar to most other salmon, yet it's very hyped and marketed. And ESG is similar in some ways to Copper River salmon, that there's a lot of hype and there's a lot of marketing, and when you run the numbers and you say, oh wow, maybe Tesla's performance of stellar 2,000% gains over the last 10 years have really affected the whole ESG market. And then when politically Elon Musk fell out of favor, ESG dropped Tesla and kept like Ford or General Motors, big, diesel truck makers, like, wait a minute, is this really ESG, or is it not as pure as it's been marketed or hyped? So there are always promoters out there, marketers, hypesters, and the waves come all the time. So you have to be aware, and you have to be sophisticated to not be sucked into that. It's existed for a long time. So if you think about the railroads in the early 1850s, 1860s, 1870s in the United States, hundreds of companies said rail's going to change everything. And they made their own different gauges of rail. They had their own different sizes of cars and engines, and they had their own private tracks. And people invested life savings in a couple hundred different companies. And basically 4 survived and thrived. A lot got bankrupt. Some got acquired, but it was game changing. Like, you can still to this day move more freight per pound per dollar in rail than you can in any car or truck or airplane. and it's very efficient for transportation. And our rail network is fantastic, and it's helped lower the cost of goods for every person in America, being able to transport these things. So people invested in it in a wise investment thesis. Rail will change. It's a great technology. AI, similarly today, will change things. It's a great technology. There's hundreds of AI companies. I'm on the board of one. We'll see if the 4 winners in 20 years are the today leaders or hypesters in the market.
Yeah, I've definitely observed a similar thing with all these AI companies popping up. It seems like there's a new one every single day. But I had another question about, you mentioned passive, or more emphasis on passive investments. Mm-hmm. I was wondering whether you thought that not just institutional, but retail investors being more invested in passive, funds, whether that's causing I guess you can call it a positive feedback loop on things like the S&P 500, and whether that's leading to artificial inflation that doesn't really reflect.
100%.
Yeah.
It is documented. There's well-researched evidence that this positive feedback loop is altering the valuation. And we used to have, I think, 7,000 traded publicly securities in the 80s. And there was a Wilshire 5000 index that tracked the whole US market. Well, today, there's only 4,200 companies publicly traded, and the Wilshire 5000 is short 800 companies in its tracking, which is fascinating to think about all this consolidation. And all of that passive money is not necessarily dumb. You don't want to overpay for something, and you certainly get a tax benefit when you are passively investing, not actively trading, where short-term capital gains are taxed at a much higher rate than long-term capital gains. So an after-tax investor, which most private investors are, really should care about how much they're paying in fees and how much they're paying in taxes, because they can control those two things. You cannot control the market. It's going to do its own variable ups and downs. The volatility is inherent in people trading. Now, the volatility has come down as there are fewer stocks to trade.
Yeah.
The volatility has come down as people are more sophisticated, thinking more long-term, not trading as much, being educated on taxes. So volatility can spike during periods of distress or bad news cycles, but volatility has come down over time because of so much passive investing. So it's very, very interesting to think about. On the long term, a basket of stocks will include great companies, and it's okay to have bad companies in your basket of stock versus put all your eggs in one basket or a couple baskets that go south and don't turn out. So overall, it's a good thing, but a bad thing is this positive feedback loop.
I see. And do you think that this positive feedback loop could come to an end? And if so, what would be the catalyst that would cause that?
Could it come to an end? I do not think that is likely. I'm trying to extrapolate probable courses of action. Anything is possible, but the idea of stock pickers outperforming these broad indexes is really evidence-based research conclusively proved to be almost impossible. Now, you can put 1 million monkeys in front of 1 million typewriters over 1 million years, and one of them is going to type out a Shakespeare sonnet, and people are going to go, put him on a magazine cover, he's a genius. And that's similar to stock pickers. So, I've had a personal one-on-one conversation with Warren Buffett. He is amazing, he's this great investor, and maybe he's also one of the monkeys that got lucky, and he's made some bad investments, and he admits it. And it's really hard to say. And Warren Buffett has given advice to others. Look, if you're not doing this full time, and maybe even if you are, you should have some passive investments, just buy broad market index.
For sure. All right, well, to transition a little bit, I was wondering, or I noticed that you had various entrepreneurial experiences. I was wondering if you could delve into that a little bit.
Sure. So working at Goldman Sachs with uber elite clients, working then on my registered investment advisors with multiple billionaires, 5 different billionaires I advised. I wanted to strike for the fences and try and hit a home run as they did. And so I had an opportunity. I had my own hedge fund at a point that outperformed the market by 300% for the time period that it existed. And then I got acquired by a bank, and they did not want me simultaneously running the hedge fund. So sadly, I turned that off, and returned great returns to my investors for that period. But the non-compete that I had when I sold that business to the bank, I decided to strike out and try to become a client of a big firm, although I would always invest for myself, having some confidence from training and experience. But I just wanted to swing for the home run. And I had the opportunity. I did some angel investing. I've done probably 20 different angel investment deals, and I've looked at many hundreds of deals that I did not write checks for. But I thought, okay, I came across this angel investment. Just 5 guys started a company that was very interesting. It was the only virtual reality company in the world that was free roaming, untethered at the time. So everyone else had wires, and you were stationary, and any motion made you sick because you weren't actually moving. And they had multiplayer, multi-user. So no one else had this. And I said, not only will I invest in the company, I want to join the company. I have free time based on this non-compete. And we were swinging for the fences, and COVID basically killed it. Putting on and off a headset from some other user, there's a hygiene protocol that we tried, but COVID was really a killer of that business. So it did not succeed, although Microsoft and Anduril right now have a big Army contract for an augmented reality helmet for soldiers, where they can get real-time information of their Blue Force friends and their Red Force enemies that have been identified by drones or satellites or friendly forces. And it's fascinating. Now, it's tough to keep cool and air-conditioned, and it's heavy on your head, but each iteration of it will get lighter and faster and better. So we'll see what happens.
Wow. Okay. So I have a lot of questions about that. It's very impressive. A lot of, from the hedge fund to the VR, it's a pretty wide array of entrepreneurial experiences.
Yeah.
But I guess I'll start off with the hedge fund.
Yeah.
So you mentioned you outperform the markets by 300%, which is like a relatively shocking number. It's pretty much unheard of.
Yeah. Now it's very short-lived.
Yeah. I was wondering how you were able to essentially pitch that shocking alpha to investors, especially because when you hear 300%, you think the first thing you think of how is this short? Is this only going to happen for 1 year? Did you get lucky?
Yeah.
What's the best way to pitch that for long term and sustainability?
Yeah, I think I was a monkey on a typewriter. So it really was about 9 months versus the MSCI World Index, and it was a global macro long short. And it was friends and family. So I was not pitching this hard to any outside investors. I had the full, LP legal and accounting, hedge fund work, custodians, prime brokers, and it was relatively small. Had I continued it to be more than a year, I might have gone out and pitched it heavier. But again, any 1 year can be a total anomaly, monkey typewriter. So I thought I've done well. Now I've had ups and down years personally investing since then, and I have not outperformed by 300% since then. So maybe it was a monkey.
So even 1 year of that much performance is pretty impressive. And I guess adding on to that, I was wondering what do you think the best strategy would be to pitch an investment system or strategy to investors, and to show that your alpha really is long term and that you can going into it.
So the most sophisticated investors are going to see that alpha tends not to be persistent. So there are great performers, and Bill Miller is a famous one, Legacy Value Fund. He bought Amazon early on, which people don't think as a value investment, as a hyper growth company, but he described it, and he ended up being right, but he outperformed the S&P for so long, and Amazon was a huge part of that. And then he didn't outperform. And after 10 years of significant outperformance, he then went down and down and down and down in 4 straight years, and his fund lost over half the money they had amassed. And he retired, and he made a lot of money himself, but pitching anyone on persistent outperformance is very tough, There are some quantitative funds, these hyper quick traders, and there's one fund that's a fascinating case study called Renaissance Medallion.
Yeah,
James Huns, yeah. He created this fund, kept it small. It's quantitative, a particular algorithm, and they have done better than Ray Dalio. And I actually interviewed with Ray Dalio to be part of the management team of Bridgewater. And I have a good friend who works with him there, and its performance is spectacular, but Simons is even better with Renaissance. And Renaissance has a program, they want to keep this nimble, so a smaller fund that's done so well. They haven't taken new clients for like 25, 30 years. But they had an employee fund where their pension could invest and their retirement savings could invest in a similar strategy but not identical. And that fund underperformed. So they're using the exact same or similar, they can't use the exact, and for employees, for their retirement, to retain them and reward them for their hard work. And that fund of similar but not exact nature underperformed. And so it's wild about what persistence is and what can be done.
I see. So even the perfect fund can never really be perfect in the long term.
Well, yeah, so the nimbleness that kept it doing its own thing was interesting, but you would think you'd reward your own employees, and they just weren't able to do it.
Sure. All right. Well, I guess another question I had regarding, adding on to that regarding persistence, with your experience as working in wealth management, I was wondering how you essentially convince your customers to stay calm during times where you might be having drawdown, or maybe if the overall economic situation of the market is not doing so well.
Right. Great question. So behavioral finance is an important concept to think about. People tend to act emotionally and irrationally. And after your health, your wealth is like your second most important thing in a lot of cases, health, family, wealth. And people panic when they think they're losing money. I try to convey, not always successfully, and sometimes I wish I had a psychology degree instead of my engineering and my MBA in investment management, the psychology idea of painting the markets as a wave that is always in flux, always moving, like you're on the ocean and it's hardly ever calm. Humans are programmed to lock or anchor on a number or some linear idea. And so they see a number on a statement, they see a number on a screen display, and they think that's what I'm worth. And the next day it's down X percent, and they can have a panic attack. People knowingly, this is also research-based, value risk and aversion to loss more than they value gain and a healthy return. So they will overweight their aversion to loss to gain. And very importantly, this is a super key concept. I actually wrote an article on this. There is short-term risk and long-term risk. Long-term risk is you lose the purchasing power of your money. Short-term risk is you lose that percentage of your portfolio. So people often think short-term, they overweight short-term, and they keep too much cash. And then they can't buy something 10, 20, 30 years down the road because that cash was in a mattress or was in a bank savings account getting very little percent return, and they've lost purchasing power. That's long-term risk. Stocks are basically one of the best inflation hedges, and the equity in companies participates in their ability to raise prices as inflation goes up. So it's really important to have some exposure to stocks to help you over the long term mitigate the long-term risk of purchasing power loss.
I see. So essentially increasing the vision of your customer past the short term, and also dequantifying it so they're not thinking, no, today I lost X amount. This is not a good investment.
Right. And a picture's worth 1,000 words. And I used to have a chart that I would show clients that tracked from 1927 to today the S&P 500. And there are a lot of dips in there.
Yeah.
There are many, 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 many dips in there, including recessions and even a depression. And yet, if you had pulled out at any bottom point, you'd miss all this upside. And that picture was very powerful to convey the story of, stay the course and don't panic and sell at some bottom. Because there are stories that are legend of people selling at the bottom and they could not recover, the portfolio could not recover.
I see. So a lot of it's emphasizing the long term and ensuring that your clients aren't focused on that short term vision.
Yeah, and it's that educational component in that picture with 1,000 words, that chart. Ask them to point to a point, and they all say, wow, yeah, the person who stayed calm and stayed invested and didn't take a tax hit for selling a winner, they did better overall.
I see. So that's one behavioral bias that you've seen among clients. What are like some other common behavioral biases, especially among like the more wealthier clients?
Yeah.
You mentioned you've worked with billionaires before.
Yeah, there are anchors on favorite companies. So try to use the example of Xerox was the first photocopying major dominant player with 95% market share. And people had rode that stock for decades, including family members in Rochester, New York, who just couldn't imagine ever selling or diversifying. And it paid a dividend, and Xerox became a verb. Yeah. People would say, go Xerox this instead of go photocopy this. They were everywhere, and everyone knew how dominant they were. And people, when they're rewarded over time, that pattern locks in their head, oh, there can't be any risk here. Well, Xerox lost 99% of its value. Yeah. And some people lost their lifestyle. They had to sell their mansions and their private jets and their yachts, and they should have diversified. Similarly, Kodak had the first digital camera, didn't exploit it. They made all this money from film and processing, and people held Kodak stock and rode it to the bottom because they thought, wow, how could any company with 90% market share not succeed? And I've had a pattern of year after year after year of success, and it's reinforced. Why would I diversify or hedge that position against loss? Because hedging is very expensive. It's like buying insurance for your house or your car. If you never have an accident in your car and your house never burns down, that insurance you paid, those premiums, is zero value. It's gone to dust. Insurance on a portfolio is much more expensive generally than house or car insurance. And so people really hate the idea of paying a premium to see it go to zero. But there are some people with risk profiles that need insurance because they can't handle these losses. Some people take that advice, some people don't.
I see. So it's definitely good to maintain diversified, especially with clients' money, not put all your eggs in one basket.
Right.
And do you see similar patterns like even today with things like NVIDIA potentially, or a lot of these hype stock that you've appeared, like Palantir as well?
Yeah, such a good question. So NVIDIA has been a total moonshot rocket ship, and people just get locked in this pattern reinforcement, and it's very hard to say, hey, diversify or hedge. And there are a few people who've sold some and they were buying a house or a boat or sent their kids to college without any burdens, and then they're mad at themselves for taking the advice to diversify. Yeah. And I had a client who had $100 million in one position. Wow. And the stock had gone through the roof, and he was a significant shareholder of this stock, and he wanted to be a billionaire. Okay. And I said, hey, there's a lot of competition in that space. Yes, it's been a rocket ship for you, but just take some off the table and you'll be in a better position, just sleep at night position. And he's like, you don't understand. This is my way to be a billionaire. It's going to be $1 billion. And we would argue. And I finally got him to put a hedge on for $12 million of it. And his wife even said, you guys go outside. You're arguing too much disrupting the household here. And that stock went to zero. It went bankrupt.
Wow.
The only money he had left is what he had hedged with me. And he was very angry that I didn't push harder. And I said, your wife kicked us out of the house. We argued over and over, weeks and weeks and weeks. And he's still mad to this day that I didn't push harder. And that can happen. And the alternative is to that is we're in the land of Microsoft. There's people who followed advice to diversify, and if they hadn't diversified, they'd be much wealthier. In fact, Bill Gates would be a trillionaire right now if he had not sold one share of a stock. So there are counterexamples for every example, but those ones are minuscule and tiny. And again, what's your risk factor? Is it really important to be a billionaire, or do you really have a comfortable lifestyle you should try to secure and sustain?
I see. So obviously that client was focused on getting rich, but overall I was wondering if you, while working in wealth management, prioritize maintaining wealth or growing wealth overall for people, or building wealth?
I try to prioritize the individual client's objectives. So if a client really wanted to swing for the fences, I would find them more high alpha seeking, but much higher risk, and I'd try to educate them on that. We had a client back in the day at Goldman Sachs who had hundreds of millions of dollars in just T-bills.
Wow. Okay.
Which roll over, 30, 90 days, and they just didn't want any risk. And they got very healthy payments on the T-bills to the point they couldn't even spend as much money as they're making on the interest from the T-bills. And they said, I'm making millions of dollars a year, and I don't need any more. And Goldman tried to say, well, you could, become charitable and really help the rest of the world here. And we have these philanthropic funds, and you could have higher return this way. And you could buy a sports team or build more companies or loan money to women in India to start businesses. And you could do all these things. And they just said, we don't want to, we don't need the risk. And we just like this sort of most assured guaranteed, not guaranteed, but most assured income maybe in the world is U.S. Treasury T-bill. And there was conflict in this advice because Goldman did want to push him into some of the higher alpha products. So I saw that as a young professional, that it was interesting advice, but the clients didn't want to own a sports team. They didn't want to become charitable in their push. And so it was very interesting how people dealt with that.
I see. So a lot of it's subjective to who the client is.
That's the way I ran a practice of advising people. Some people have gotten in big trouble putting people in way more risky investments than they should have been. And some people have totally lost out to inflation because they were super conservative for 30 years and they totally missed the rise in the markets and the loss of purchasing power of a dollar.
Yeah, well, I think I agree with your philosophy pretty well. It's not supposed to be like a stock brokerage. You're trying to sell the stock.
Right.
Anyways, I had a question regarding T-bill, or your client with T-bills. This sort of changes the topic a little bit, but I was wondering what you think would be a good alternative to T-bills, maybe in a time when interest rates aren't so favorable and T-bills are providing less returns.
They are a U.S. government security backed by the full faith and credit of the United States. So I don't know that there's any alternative to a T-bill, and it's totally short term. So you're not taking duration risk that a longer term, a 30-year bond, a 10-year bond would have, which really changed in value. And people have lost lots of money holding long-term bonds, even U.S. government bonds, if they sold at a bottom when the bond market was really suffering. And the longer you go on a bond, the more interest rate volatility will affect that value. And short-term bonds, it's just, there's hardly any alternative that I can really think of. I am not in favor of gold. It's had its ups and downs. It was used as a currency for millennia, but people don't use it as a currency anymore. There's a famous video of a guy going around the world, Australia, Egypt, Moscow, London, Paris, Tokyo, San Francisco, New York, with gold coins.
and they're Maple Leafs, they're Krugerrands, or Eagles, and he's just trying to trade for something of low value. The coins are worth $1,000 at the time, and he's like, I just want a $50 meal, or I just want a $25 bus ticket. And people aren't used to trading in gold, and people have been scammed by lead painted gold, and so he failed. And huge discounts, right? Who wouldn't give somebody a $50 meal for a $1,000 gold coin if you knew? But people just don't have that experience trading. And so gold has no yield to it. There's an important lesson in investing. Something should have yield to grow in value over time, to produce something. The way a crop has a yield, you get corn from this field, you get rice or apples or cherries or whatever. That yield is the same concept of a bond paying a yield, a stock paying a dividend, and gold doesn't pay anything.
Yeah.
It could be seashells if it was limited quantity and hard to mine. People value seashells because they're pretty. So like, gold is just whatever the world thinks seashells should be worth at that moment.
I see. So generally, like opposed to to an asset being strictly based on supply and demand, like gold, for example.
Well, so there's artificial supply and demand. Governments come in
Yep.
and play with that. There's an options market on gold, so that's a derivative market that totally affects the pricing of it versus just pure supply and demand. And then there's hoarders. There's people that use it and consume it in that they buy it and put it in a basement or a safety deposit box, or they're safe. So the supply and demand of gold, demand moves with this irrational sensation of value to what gold is. So if something has a yield, something pays 3% year over year over year, you can put a value on that. You can run the math and say this should have this value. And if a crop, people will buy this orange farm because people want orange juice and navel oranges, and each year we've been getting this yield out of this crop, and we expect it going forward, and they'll put a value on that yield. But gold, there's nothing to put a value on other than how people feel on Tuesday.
Yeah, I can definitely see that sentiment being true for gold. But speaking of changing currencies and changing value, obviously people in the 1800s valued gold more than the dollar, maybe even earlier. But what do you think about Bitcoin and I guess decentralized finance as a whole? I know there's a lot of sentiment about implementing that as a new currency. El Salvador, I believe, adopted it as an nation's currency. What do you think about that?
This is a super topic. We could write a book on this as well. I was introduced to the idea of Bitcoin by a neighbor in 2011. Wow. And he put $25,000 in when it was, I don't know, $1.80 or $2.20 or whatever it was back then. And he said, Brian, just put some money in it. It's this hedge against government fiat currency that every empire in the world has printed money in excess and inflated their currency and devalued the purchasing power. And it's just this hedge. So I looked into it at the time, and I said, the fact that it's anonymous, this Satoshi, is a red flag. The fact that it's being used for some illegal activities right now is a red flag. And I personally just don't know enough coding to dive through the code and figure out if there's a back door that the founders can just steal money out the back door. So I passed, to my regret. He sold as it doubled and tripled and quadrupled and 10x in value, and he actually sold all of his stuff when it hit $1,200. He's like, this is just insane. So, but he made nice money on his investment. But to this day, I did get into Bitcoin as a hedge against government fiat money. As we continue to deficit spend, every other empire in recorded history printed money to recklessly spend on incurred debts that were not essential to their survival, and they eventually collapsed from this huge burden of debt and this deficit spending. And we don't show much reform mind in this sense, or historical mind. Ray Dalio's on a huge pitch right now. He's written books on it. He gets on every talk show that he can be on. He has podcasts. He has LinkedIn comments, and he is constantly trying to educate people on the danger of this super debt cycle that other countries and empires have failed. And we are on a bad path. So I actually do think Bitcoin has a value in hedging against government fiat currency and devaluation of that currency. What I don't think is currently valuable is this DeFi, decentralized finance. The idea that you will get yield in these other currencies by letting people hold your Bitcoin.
Yeah.
I looked at it and I do not buy that it's real value. It looks like smoke and mirrors to me.
Yeah.
And there are people that love stable coins. They love the idea of having collateral against something and someone's paying you some interest to hold it. As I looked into those, it looked like a bunch of cross payments to each other.
Yeah.
And this big maze that when you started pulling the strings apart, the DeFi seemed like a total scam, not real.
Yeah, I can definitely see that. There's been a lot of scandals in the past with decentralized finance. It's definitely a early development and maybe even scandalous one. And you mentioned Bitcoin as a hedge. Do you think that in the future that value as a hedge is going to increase even more, especially with like Bitcoin and a lot of like different cryptocurrency exchanges like Coinbase becoming more SEC regulated and it becoming, I guess, more legit overall?
So yes, the reason I have it as a hedge is I think the government's going to devalue our currency over time. So I think that value will increase of Bitcoin, and it could go from 100,000 to 200,000 to 500,000 to 1 million. I don't know where it's going to go. I have a theory that at some point when we start approaching the asymptote period of 21 million limited issue, that there'll be very little incentive to mine unless there's giganto transaction fees. So one of my good friends who's been in crypto since 2017 and actually mined it for a bit with his teenage kids, I told him that I could see a day, not today, and I'm still holding Bitcoin, but I could see a day in 20 years where Bitcoin's worth $300,000 or more, but the transaction fee to actually pull your Bitcoin out and trade for something of value may be $180,000, because you need an incentive to mine to run the blockchain and have the nodes all agree that this transaction's here. And if you have very limited Bitcoin out there, the transaction fee is the only way you're going to incentivize people to do this. Now, there's also a huge risk of quantum computing breaking Bitcoin code and personal wallets. And so that is a risk that may happen before this 20 or 30 or 40 year time frame that I'm projecting out, where I told my friend Bitcoin could go from $300,000 in value in 2040 to $500 in 2045.
Yeah. So
It totally happened.
it's definitely safe to say Bitcoin, well, this kind of adds into the don't keep all your eggs in one basket argument. Bitcoin could lose all of its value, and that definitely wouldn't be good for any investments.
Right. And governments in the past have outlawed some investments, including gold. The U.S. government said U.S. citizens cannot privately hold gold in our past. And so they might say you can't hold Bitcoin. It could happen. So don't put all your eggs in one basket.
I see. So kind of leading back to what you mentioned about like increasing like U.S. debt, feel free, you don't have to answer this. What do you think, because it's kind of like it could be a political question.
Yeah.
What do you think about like the implementation of tariffs and how that might impact, I guess, U.S. debt at the moment?
Yeah. It is a fascinating subject. And every other country in the world practically uses tariffs. We're about the only one that doesn't. So if everybody else does it, it can't be as bad as we've been mythologically programmed to believe. There is an interesting component to tariffs in that it is a consumption tax versus a wealth tax. So if you use a lot of stuff, you're going to be paying that tax. If you don't use a lot of stuff, tariffs should not affect you that much. There is a potential to protect some industries that are vital to national security: steel, AI, artificial intelligence, energy, chip making. There are some very good reasons to not be dependent on an adversary for your supply chain. And that's historical over millennia. So I do think there is a lot more complexity and nuance to evaluate with tariffs. And sometimes people throw out the idea of a tariff or a temporary implementation of a tariff, and they pull it back when they negotiate some position. And the US has the number one position of strength to leverage any negotiation by threatening a tariff or a short-term implementation of tariff. So I don't know how this will play out. It could play out beneficially with tariffs collecting a lot of revenue for the US and only punishing or taxing those who are consumers of the things being tariffed. And it may protect us on a national security level. It could also lead to inflation, and it could lead to reciprocal tariff increases that hurt us in the short term. And we have the flexibility to take them on or off or renegotiate. So it's not permanent, it's not all or nothing, it's not either or, zero sum. So I try to have an open mind and look at giant context when any subject comes up.
I see. And regarding like tariffs effects on market pricing, I know there's like a lot of like discussion over this. Where do you see it affecting markets like in the short term and long term?
Yeah.
Especially because a lot of people are talking about like investing in like emerging markets instead, and I guess moving out of the US.
Yeah.
I was wondering what you thought about that and what, if it's justified.
I could write a whole nother book on this one. Emerging markets have the most demographic growth projections in the next 50 years. People are having babies there, and the West G7 countries are not having babies as much. And so there will be a lot of consumers. There should be GDP growth in those emerging market countries. There's a famous author and economist, Hernando de Soto, who helped these emerging countries adopt Western practices of rule of law, reward for entrepreneurship, and property rights. And those things did not really exist in those countries. The brother was the chief of police, the uncle was the mayor, the grandfather was the factory owner, and there was this cronyism and even caste systems that just kept people down and did not have the prosperity and wealth in these countries that the US had from those three things. And so those countries have adopted those things in large measure. Now people are getting, with property rights, they get access to credit that they didn't used to get. And rule of law, you can't just have your brother as a mayor just say, oh, you're going to jail because you argued with me or hit my car. And the reward for entrepreneurs is, hey, innovate, try new things, let's build this. And there ought to be a drive. There's another book called Abundance that came out recently in the last 5 years or so, where there should be, with lower energy costs, especially as we embrace nuclear, that's constantly on. You don't have to wait for the sun to shine or wind to blow. And there's no carbon emissions from nuclear. And the US Navy hasn't had an accident in nuclear in 70 years of use. If we get very low cost energy, there should be an overabundance of things to feed people and clothe people and house people, and the emerging markets should benefit a lot from this abundance idea. I like emerging markets. I have some exposure to emerging markets, but they have not produced to the vision of the last 20 years. They've woefully underperformed.
Yeah, I've seen that as well in like the past, I guess long term in the past, emerging markets have been underperforming compared to developed markets. And only I think in the past like few months in the short term, they've performed pretty well, which is, or outperformed their expectations, which is why I asked the question, because there's a lot of discussion about it online. And I guess slightly related, I had a question regarding like how you choose companies, whether you because this is obviously about like where we spoke about like economic factors and how they influence like I guess market pricing or specific pricing for stocks. But I was wondering if you value things like, I don't know, like DCF analysis or like some of the parts models for valuation, and whether that's just like another additional factor or a key part of your investment thesis.
So growing up and getting trained discounted cash flow was a huge component of what we would assign to what we thought a company was worth. And we did the capital asset pricing model. We paid attention to a lot of different metrics, and the market can be irrational longer than you can be solvent. So if you take big bets and you use leverage yourself, you borrow money to invest, and you're wrong, you can lose everything. And so you have to apply some behavioral finance, which discounts the DCF and CAPM. And there are people who just absolutely love NVIDIA. And Palantir, we brought that up. Palantir has a valuation today of over 100 price to sales. Every other company in history that had that, 7 or 9, I can't remember how many, all of them lost more than 70% of value. So could Palantir be the anomaly? Sure, totally could be the anomaly. But it's more likely it joins that club and falls. Over 100 times price to sales is absurd valuation. Now, there is a break of all logic where Amazon didn't earn money for 20 years and then became a juggernaut and now mints money. But they reinvested, they got money from the markets, and they didn't make a profit. And usually if you don't make a profit after a year or two, markets are severe, banks, creditors are severe, and going concern issues really rise. But it was so innovative, it was so customer focused. There's books on why Amazon's so successful, but they taught people you don't have to be profitable for a very long time. Smartsheet is a company that went public here, has been acquired, go private for $8 billion, and it didn't make money for many, 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 many years. And the model has changed on how people value. They really value growth. And so the old dividend-paying, value-oriented companies have not kept pace as the market has just assigned a huge value to growth, even without the need for profits or dividends.
Yeah. So I guess in the past there's more emphasis on the numbers don't lie, financials and valuation, but in recent years, a lot more of these growth companies that maybe aren't profitable right now have been, I guess, experiencing positive outcomes in their stock pricing, right?
Well, I'm going to start with a premise there of the question. Numbers have lied in the past because people have faked numbers. There's been public companies, there's been advisors, people have lied about numbers. Numbers have failed. Xerox and Kodak had the best numbers of market share, crazy profits, history of dividends, and they totally failed. People have also gone crazy for the Nifty 50, which is an early 70s idea, and Xerox and Kodak were in those Nifty 50 stocks where people went for hype and they didn't care about the numbers as much as the growth and the niftiness, the cool tech part of it. So it has always been, from tulip mania in 1600s in Holland, an idea that waves of investors come into hype and marketing and promotion of something. And there have been value investors, Benjamin Graham, Warren Buffett, who've said, look, we're just going to buy dividend companies. We're just going to stay with our knitting and things we know. Peter Lynch, Fidelity Magellan, just avoided these things they didn't understand. Now Apple became one of Warren Buffett's greatest investments, and he avoided it for the longest time, and he didn't buy Microsoft for the longest time, which he should have and could have, and cemented his record even more. But there are people who've been successful with value-oriented investing, not being part of the herd.
I see. And overall, though, like discretion is probably important, right? Like maybe not strictly sticking to valuations or strictly sticking to like, oh, I think this company's doing something innovative, or just I guess general developments in a company. Just having a good mix of everything is important in investing.
Well, so to that point, the broad market index gives you exposure to the whole deal, and you don't have to apply as much work, and you don't have to be right about work on valuing a company. So the hard work of valuing a company goes to the private side, and the private side doesn't have daily transparency. There's benchmarks, and they use proxies to try to come up with values, and it is what the market will bear, similar to the buying of a house or a building. Like, hey, not everybody likes the paint on that house, or the 2 stories in that house, or the terrain on that house, that live on a hill. And so it's what the market will bear. For the private markets, on a more selective basis, there's not as many buyers. The broad market has a lot of buyers, but you have a lot of index folks that are just pouring in part of their paycheck every month, not paying any attention. It's going into this index fund. And so you have that positive feedback loop, but you don't have the same risk of being wrong. And if you're dollar cost averaging, it should turn out well for you over time.
I see. So it seems like everything comes back to passive investing.
Not everything.
Well, not everything.
It is fun to try to outsmart the market.
Yeah.
It's highly risky. It can be very rewarding. It can be very punishing. You can do a portfolio that encompasses alpha seeking, higher risk, and more stable, less volatile, broad-based market indexing with low fees and low taxes. You can do the whole portfolio.
For sure. All right. Before we wrap this up, I have one last question. What is one piece of advice you give to the youth regarding who are interested in getting into finance or maybe like entrepreneurship like you've done?
Great piece of advice. Everything in the world basically assumes risk, and the higher the risk, the higher potential reward, and people tend to be averse to risk. And so I would say, do not be so afraid. Now more than any time in history, you can afford to fail at something, and it's not going to be life crushing. You can fail at a startup company. You could fail at a particular company, joining the next Xerox. It's not the end of the world. You can go do something else. You can join an AI startup and it might fail, and it's okay. It's probably going to be more fun than if you join some giant big corporation where you're just a cog and a number. And smaller is more nimble. You can move faster, and you can be a bigger fish in a smaller pond. And so some people love to get the resume with the gold-plated credentials and companies. I think being more entrepreneurial, more risk-taking, joining smaller outfits will be more rewarding to people, and the risk of failure, it's not as bad as it used to be, where you would be tarnished and your esteem would be held lower. You can go out, you can take risk.
I see. I completely agree. I think that's especially true for people that are just getting into their career, especially when they're young, when they don't have much to lose, and exploration is valuable.
Yeah.
All right. Well, thank you very much for this discussion and interview. I learned a lot, and it's a great experience. And for the listeners back at home, tune in for another episode. And this is Mr. Brian Vowinkel. Thank you very much.
Very good.